wherever there is capex is my investment universe. We have seen dramatic improvement in the government capex in the last 7 years in 2014 to about 10 lakh crore from 3.2 lakh crore.
The correlation between the sectors are on the higher side, and is that going to affect the diversification as well?
If I am convinced about an idea, do I need 200 names to back that? Fund will have a very concentrated holding. But otherwise the investment horizon or the objectives remain broadly the same between a mutual fund or a Bharat Nirman. We have managed close to $2.5-3 billion of capital.
Do you think India can grow as fast as China did, considering China grew during a global development?
The 7 market crashes have happened because of some global events. We may not understand everything what is happening globally, but we need to be cognizant of what is happening globally.
We have seen increased book value because of government spending on infrastructure. How far do you think this growth will go, and do you think there are any challenges with this? So we have our guest, Mr. Natraj S, the fund manager of DSP Bharat Nirman Fund. Mr. Natraj brings over 22 years of experience in managing equity assets in emerging markets with a proven track record that includes managing more than 3 billion in equity assets. His extensive experience spans across various roles, including his tenure at Quantum Advisors and managing a 25 million closed-ended fund. Welcome to the podcast, sir. It's my pleasure to sit right next to you and have this discussion.
Thank you.
So before we dive into the discussion about AIFs and sector-specific insights, I would like to know more about your background. How did you end up in the fund management space?
I passed out of the business school in March 2000, and one of our professors in finance was kind enough to introduce to one of the founders at Quantum Information, Mr. I.V. Subramaniam. And I went and met Subbu, as he is called, and then he liked my approach and he said, why didn't you join on the equity research side? I joined on the sell side of research in March 2000. And over the next 6-year period of time, I became the head of research at Quantum Information, which used to have which still has a very popular website called equitymaster.com, which is an independent research supplier to retail investors and high net worth individuals without a broker link, non-broker link. So from there, I moved to Middle East in 2006 end, to be part of on the buy side, on the fund management side. And I was in Muscat, where I was co-managing a GCC fund, which was long only. And that I got exposed to the nature of fund management. While I knew Quantum itself, how fund is managed, how long-term allocation is done, how long-term research works, that was the first experience managing that. And when I came back to India in 2010, I again joined Quantum Advisors, but on the buy side this time, managing money for the pensions, endowments, and the family offices based out of either Canada, Switzerland, or US or Europe. That's how the fund management journey started, with not knowing background of research, stepped into research, eventually progressed to do multiple stuff, managing India, GCC, global emerging markets, ESG, and now to Bharat Nirman Fund.
So I'm going to ask a very monotonous or a repetitive question. It's about the AIF. So in India, it's being familiarized. So in the US, it's very common. But in India, people are starting to get into it. So could you please give few more details about AIF, how it works, its structure, the Cat 1, Cat 2, Cat 3. If you could give a brief detail about that.
So I will just talk about Cat 3 because that's what I do. The other complexities are slightly different. Cat 3 is predominantly for listed equities. Irrespective you call it mutual fund, AIF, PIMS, at the end of the day, we are all money managers. The vehicles are different. The taxation forms are different. The advantage and disadvantages, each has its own advantage, each has its own disadvantages. The way I look at AIF is that when you have a like-minded capital of, pool of capital available, which is not susceptible to daily, monthly, weekly flows like a mutual fund would have, and the fund manager would have discretion to allocate capital when he sees or she is the most valued at that point in time, go fully invested or stay in cash, which in a mutual fund becomes challenging because certain amount of cash people start, it's regulatory, there are some constraints and stuff like that, whereas in a Cat 3 AIF, you can be anywhere you want in terms of cash. So those are the broad contours.
So my next question is on the similar lines. So how does a Cat 3 AIF like Bharat Nirman Fund differ from a mutual fund that serves on the sectoral lines, on the similar lines? So apart from the structures, are there any other differences that you mentioned earlier?
Barring the fact that cash levels could be different at different times in a AIF3 structure, I don't see fundamentally how it is different. The difference, for example, between a Bharat Nirman fund and let's say a DSP Tiger fund is that we aim to have only 30-35 stocks in the portfolio, whereas DSP Tiger has more than 65 stocks. Today it's about 70 stocks in the portfolio. Because I have managed only conservative, concentrated portfolio mandates, the Bharat Nirman fund will have a very concentrated holding. But otherwise the investment horizon or the objectives remain broadly the same between a mutual fund or a Bharat Nirman. That we have to compound earnings over a period of time, identify great companies, stay invested over the long period of time. The scope remains the same. The vehicles will have its own nuances in terms of the ability to be in cash if we don't see value, or ask for more common pool of capital when the market becomes very attractive. Stuff like that happens in AIF much easier.
Okay, so the Bharat Nirman Fund focuses on sectors such as building materials, capital goods, auto and auto ancillaries, chemical, fertilizers, all those. So what is your outlook on these particular sectors?
So the simple one-liner for Bharat Nirman Fund is, wherever there is capex is my investment universe. There are about 650 stocks on the sectors that you mentioned. Out of 650 stocks, I have to pick 30 or 35. That's the broad contour. Within the sectors where capex is happening, there are three levels of capex which is happening. One is the government-led capex from its own budget. One is the state-owned enterprises leading the capex, and then there is a private sector capex. Of the three, we have seen dramatic improvement in the government capex in the last 7 years, in 2014 to about 10 lakh crore from 3.2 lakh crore. We do see the state-owned enterprises spending close to 6.5 to 9 lakh crore over the next 3 to 5 years, and the private sector seeing capex is showing some sort of green shoots. If we take that as a big super helicopter view, then you narrow it down to sectors which are going to do well. All the sectors that you mentioned above will do well over a period of time. Obviously, someone like a deep cyclical sectors like a chemical or fertilizers or a steel or a material or a commodity would also be impacted by global price movements, global economic growth, how China does well. Whereas someone like a capital good company or automobile company based out of India, largely the earnings comes out of India-based factors, which is demand and supply and pricing. So we do see secular growth path ahead, but in some sectors there will be volatility for natural reasons because of global exposures. All these sectors we expect over the next 5 to 10 years to grow in line or slightly higher than the GDP growth, nominal GDP growth.
So you mentioned about government spending. So sectors like capital goods, cements, and building materials, we have seen increased book value because of government spending on infrastructure. How far do you think this growth will go, and do you think there are any challenges to this?
If you put the government capex in perspective today, the last 4 years spending, if you accumulate and work it out as a percentage of GDP, it's about 2.8%. Between 2004 to 2008 period, the capex was about 2.8, 2.9%. So in percentage terms, the capex that we are seeing from the government is not too different, but the quantum is different because of GDP base has gone up. The government has clearly announced its intent to at least continue to invest in infrastructure, continue to invest in sectors like defense or modernizing railways or modernizing existing airports and stuff like that. So the capex visibility from the government, we do expect them to grow slower than what it has in the last 6-7 years. The government budget estimates itself talks about 10-11% growth. That is one way to say that even if the 10 lakh, 11 lakh crore continues, it's a good enough start for us. Having said that, if that 10 lakh crore were to come to 9 lakh crore, will all things fall apart? My answer is no. It's still a 9 lakh crore incremental spending. As long as there is a clear directionally push from the government saying that we are continuing to invest and allow private sectors to participate more, then the growth prospects are promising.
Okay. So our fund aims to diversify across 30 to 35 companies, and we are planning to target those companies trading at 15 to 20% discounted rate. So my question is, could you please elaborate on how you determine the fair value of these companies and what factors you consider in concluding that they are trading at a discount?
There are two ways to look at it. One is the intrinsic ability of a company to grow.
Okay.
That growth is a function of how the sector grows. For example, take example of a cement. The last few decades, cement demand in India has grown by 8% compounded, largely led by housing. Infrastructure has picked up in the last 10 years. We have seen increased activity related to that. We do expect across commodities, across sectors in India, if you take the per capita consumption right from automobiles all the way till cement, we are much lower compared to even some of the emerging markets.
Okay.
Forget about the developed markets. So they would grow faster. So in the sense, if they keep that 8% as an equation, a cost of setting up a cement plant is, let's say, $100, $120 per ton, available at $50, $55, which means they are available at a discount compared to the replacement value. Now, the discount to the replacement value can sustain for a long period of time if there is no profitability improvement. We do see that changing. If an inflection point between growth changing and a discount is what we are looking for. Typically, I take a last 15-20 year trading history of companies in peers within the sector, and I also look at global emerging markets or developed market companies, what multiples they are trading at, and I apply a commonality between the two and arrive at a fair value multiple.
Okay.
And the fair value multiple is normalized multiple, and I want to buy 20-30% discount. In case of deep cyclicals, I want to buy at a 40% discount, because the margin of safety becomes much better there. So the fair value multiple assessment is a function of growth outlook, valuation that is trading today, compare that with global and regional pairs, and then see the own history of how companies are traded at within the sector and assign a discount to that. That's how it's determined.
So we talked about sectors like capital goods, auto ancillaries, chemical fertilizers. So don't you think the correlation between these sectors are on the higher side, and is that going to affect the diversification aspect?
No, not really. So if we go back and check history between post-COVID era, the earnings growth, I am detaching stock price performance to earnings growth.
Okay.
If you look at the earnings momentum of the auto ancillary companies, they recovered much faster than the capital good companies. We are seeing momentum capital goods earnings coming through round. Different, so chemical and fertilizers, they had a very, very strong tailwind between 2016 to 19. Post-COVID, there was a big recovery, and since 2020-21, earnings have been weaker for these chemical and fertilizer companies. So I don't think the correlation is that strong. By having a diversified portfolio, I think it will only benefit over a long period of time.
So are there any particular factors we decide that you guys choose to decide that no, in my portfolio I want 30 to 35 stocks tops? Is there a particular reason for that? Is it entirely based on the fund size or maybe sector specific? How is the decision made?
It's purely a conviction based product, in the sense that if I am convinced about an idea, do I need 200 names to back that? My answer is no. So in my earlier company where I used to work, we have managed close to $2.5-3 billion of capital with an average holding of about 30-32 stocks over a 20-year period of time. So size, obviously if you go down that market cap criteria into a small cap fund and say, can I manage a 30 stock portfolio in a small cap fund? The answer is no. Okay. Because you don't have the depth of trading, and therefore you don't want to influence the daily share price by your own actions of buying or selling. Okay. So it depends on the capacity. The way the Bharat Nirman strategy works is that the capacity, I assume, I think it's going to be 3,000, 4,000 crores. With that capacity in mind, I build a portfolio. So 30-35 stocks is suffice for that.
Okay, so earlier we discussed about the discount to their fair value part. So I want to ask on that lines. So could you elaborate on how you determine the fair value of these stocks and what factors you consider in concluding they're trading at a discount? Yeah, so that is my question.
Yeah, I mean, like I answered earlier, I look at the earnings growth momentum. Let's say auto a two-wheeler company or a four-wheeler company, the number of cars per 1,000 people in India is about 14. So there is still room for growth in terms of what that could happen. Over the last 32 years, car demand in India has grown at about 10-11% CAGR. I don't expect that CAGR to change over the next 10 years. The last 4-5 years has been weak post-COVID impact. If take that 10-11% is the volume growth, 2-3% is the pricing growth, and some companies would have more premium products within the mix, so the pricing growth will be faster. So you're looking anywhere between 13 to 15% growth. For the 13 to 15% growth, some companies are better leveraged in terms of their ability to improve margins from where they stand today on a normalized basis. And therefore, the spare parts and other businesses will contribute, which means the bottom line growth will be faster than that. Let's say that number is 15 to 17%. If I can buy those companies at between 14 and 16 times PE multiple for a growth which is 15 to 17% over a compounded long term, then the fair value multiple is reasonable enough. Are they trading at that valuations today? The answer is no. Because at this point in time, if you take some of the auto companies, the earnings are in weak cycle. If you take Maruti as an example, as that recovers, you will see that catch up. But in certain pockets, you may pay higher P multiple at the start because at the earnings are weaker, but that will get compensated with earnings growth.
So my next question is a comparison between India and China. So do you think India can grow as fast as China did, considering China grew during a global development time period? And now currently the world market is a bit more mature, So do you think India can grow as fast as China?
I think I'm not a China expert, neither am I an India macro expert. But if you go back and check what China did during that period in terms of their government push towards developing infrastructure, even if there was no requirement for a road or a dam or a railway network or whatever it is required, they said, let's go and build it. You build it, demand will come. That's the way they thought about it, building mega cities and stuff like that. And it had its own good things and bad things. The good thing is that it led to a significant highly GDP growth, global demand for commodities went up. It benefited including countries like India, some of the Indian companies. Our own constraints in terms of, China for instance can say, today I want to build a road here, demolish everything, build a road. I think we are a much more consensus-based economy for all right reasons, and therefore those decisions would take time to come through. If you have to approve a coal mine in a forest, I would imagine it takes much longer to get the approval in India for all the right reasons compared to China. That would have its implications on growth. I don't think we are yet geared up for that 8.5% real GDP growth like China did. That 6.5%, 7.5% GDP growth itself is a fantastic number to have. We would still be one of the fastest growing economy on a relative basis on a global scale. So there's nothing wrong growing at 7.5%.
So what are your expectations on the upcoming budget? What initiatives would provide a boost to the market, and what measures could have a negative impact? Maybe the pros and cons.
I've always believed that budget has been a non-event over the last couple of decades. It creates hype around it for various reasons. Even now after 25 years, I don't understand why. My investment decisions or portfolio selections is not based on one budget outcome or two budget outcomes. So because that's not something in my hand. What can help? What can help is continued thrust on infrastructure, continued thrust on allowing more private players to openly participate. We need more competition in some sectors like telecom or airports and stuff like that. Competition always creates efficiency. I think those are enabling architectures which the government is trying to do. If that continues on that path, I don't expect anything.
So with the global economic landscape continuously evolving, what macro trends do you think will impact the Indian market in the near term?
There are, that's what I was saying, some of the client meetings I've had. If you look at Indian market over the last period, since 1996, or even slightly earlier, the 5 of the 7 market crashes have happened because of some global events, be it Asian financial crisis, be it TMT bubble in 2000, be it global financial crisis in 2008, the Silicon Valley bank crisis, the China slowdown, or the COVID. Um, so one cannot lose sight of the fact that we may not understand everything what is happening globally, but we need to be cognizant of what is happening globally. Geopolitics is one part. US economy, health of US economy is the other risk part. Commodities and oil underinvestment in the last few years. If the Indian GDP grows faster and China picks up, the underinvestment in commodities will start to impact inflation. Food inflation you cannot solve by monetary policy in general. How can you reduce price of tomato by interest rate cut of 25 basis points? Something structurally has to happen. So these are some of the things that we need to keep in mind. More importantly, in the last 10 years, global interest rates were between 0 to 2%. Today, it's at 4.5%. US interest rates are somewhere in the ballpark. It may go down, but it's surely not going back to zero like it did post the GFC crisis. That means the reset of cost of capital.
Okay.
So these are some aspects I am very wary of. How that impacts PE valuations in a different cost of capital environment. So those things investors have to keep very active watch on, in my view.
Okay. So I've come down to my last 2 questions. Could you please share your experience on managing the $3 billion in equity assets, and how was it managing the $25 million in the closed-ended fund? How is it different from coming to India and managing something like a Bharat Nirman fund?
Honestly, in all those previous avatars, we've always managed it as a team. So I can't take credit for either good or bad. I mean, we've done good over a period of time. How we manage money, irrespective of a dollar investor in India or a $500 million mandate for a global, it's the same. Why should one be treated differently compared to the other just because the ticket size is different? So the investment practice, the philosophy, the framework doesn't change because where the money comes from or who the money comes from. The GCC fund close-ended has a different connotation. It was a 10-year close-ended money from a sovereign wealth fund, and therefore we could buy into companies and stay locked in for a very, very long time. And there was no the other GCC fund is doing well, you should do. So the objective of that fund was very strategic and therefore very, very long-termish. In a Bharat Nirman fund or in a domestic mutual fund or into the international mandates, the global mandates we used to run, not only you have to stick to investment discipline, you have to also generate returns that beats benchmarks over a period of time. And that is the only objective. If you do right things right over a period of time, more right things than wrong, I think we will get there. The source of money does not change how money is managed. That's my humble view.
Makes sense. This is one of the most common questions that I ask to all the fund managers that I interact with. You can choose not to answer it. Would you mind disclosing your current personal portfolio allocation, just a percentage?
Yeah, I mean, approximately 20% is in international equities.
Okay.
The balance is all Indian equities and mutual funds,
Okay.
and approximately 30-40%, the balance 40% is in real estate, either through my couple of houses or my parents' house that I bought and stuff like that. So that's the allocation. I also forgot to mention about 5-7% is in gold, in a ETF form. So that's the
product. Is it in cash?
At this point in time, because of all the real estate investment done, I am not too much in cash today, but I think it's a great time to also, in my view, if you invested 20 rupees 5 years back and that 20 has become 50 today, if I would have done that, I would have reduced that by 10%. So I would have taken 5%, kept it on the side, wait for better valuations to come through.
Thank you so much for your time.
Pleasure.
It's my
Thank
pleasure.
you.